Set a case efficacy chain, also known as chain of efficacy, a digital chain. A chain is only as strong as its weakest link. Educate, efficiency, effectiveness, and evolve. So whether you are doing market research, studying, doing market analysis, or making a critical financial decision, get the latest breaking, developing market news in the cryptocurrency markets at www.efficacycoin.com. Efficacy Cryptocurrency News is powered by Case Capital Markets.
Issue in a serious way. But if that does happen, then what
set of policy changes at the beginning of the administration. However, December 18 of 2024 at the FOMC press conference, you noted, and I'm paraphrasing, that some Federal Reserve officials began to incorporate preliminary conditional estimates of how fiscal policies might impact the economy into their forecasts. This seems inconsistent, and I sidebarred this. I hear correctly his question and sort of your answer. What I heard is that there was a belief that the IRA would not be inflationary, but tariffs could be. For suddenly you and others were commenting on tariffs. And for the institution, I know you try to be consensus driven. Why are there FOMC participants making fiscal policy assumptions into their forecasting when you yourself said that fiscal policies need to be articulated before the FOMC can make a plausible assessment into their implications, what those will be? And I think if there's different participants having different assumptions, that would render the SEP, Summary of Economic Projections, biased, meaningless, useless, less impactful, and when you're not comparing apples to apples. So wouldn't it make more sense for all the forecasters to make the same fiscal policy assumptions at the same time? Or if not, shouldn't each participant disclose what assumptions that they're using and building into that? So here's the question.
So that's a great question. That really, when the Summary of Economic Projections was originally designed and put into effect in this way, the way it works is that individuals are free to make whatever assumptions they want, and they do disclose them. They disclose them in their speeches and things like that. So there will be situations where some people incorporate something and others don't, and we try to be transparent about that. But that's kind of the way it works. When I say we don't take it into account, I'm really talking about policy and the committee as a whole, where we won't take things into account until we know.
And you believe their assumptions when they're including auditing the Fed and a number of other things that have gone on. I've got here need more labor. We need a few other things on it. There's no recession. That's been established. There's no hyperinflation, or certainly not as what some had been projecting. Yet there seems to be higher than expected, or certainly desired interest rates for many of us. And I'm curious how high interest rates, they hurt Americans who are paying car loans, credit cards, mortgages. You had FHFA Director Pulte asking for lower interest rates, which would obviously impact home buyers as well. So what is it that's keeping, in your mind, the Fed from what many of us believe is the right thing to do, which is to lower some interest rates, and by the way, match what the Bank of Canada, Bank of England, the European Central Bank, the Swiss Central Bank, a number of emerging central banks, by the way, that's your own assessment on page 33, as where you're laying that out. Why aren't we doing what the rest of the world is doing? Is it because we're at full employment? Is it because of those tariffs concerns that you said weren't part of the analysis? Was it energy, groceries, durable goods? Why?
So you're right that if you just look in the rearview mirror and look at the existing data that we've seen, you can make a good argument that that would call for us to be at a neutral level, which would be, a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year. When I said we weren't going to talk about tariffs and inflation, that was to say until we see what the policies are. And so now we know more. So anyway, I'd be happy to continue this with you.
Thank you.
Gentleman, time has expired. Gentleman from Michigan, Ms. Tlaib is recognized for 5 minutes.
Thank you so much, Mr. Chairman. Chair Powell, last month there was research published in the Journal of Urban Health that found that more than half of Black women of reproductive age, that's the term they use, in the counties that I represent, that had experienced some sort of eviction during their lifetime. So that's like 50% Black women in the two largest county, Wayne County and Oakland County in Michigan. And these numbers are horrific. Were you aware of that? And evictions are often very traumatic experience, but also it creates a cycle of poverty, but also this instability for many families. But especially when it comes to a lot of our Black neighbors, the access to equity, the access to housing has diminished even more. In Michigan, we lost more Black home ownership than any other state in the country during the last recession. So we know the housing crisis, I believe, is structural, and some may say it's a policy choice. While there are many factors at play, and you know this, Chairman, high mortgage rates, the finance rates and so forth, that drag the supply of new housing. But last month, new housing hit a 5-year low. Are you familiar with that?
I'm not sure exactly what statistic you are referring to.
Okay, I don't know. There was all this articles about the housing market and the impact of tariffs and so forth. And they said, again, it hit a 5-year low. And again, I'm getting this from a source, but this sets the market up for higher inflation and more burdensome housing costs to years to come. So Chairman Powell, I'm looking at this monetary whatever policy framework that you guys have put together. Do you think that the way it's structured, and again, I'm trying to understand how you're looking at this in the housing crisis, do you believe it's eroding new rental supply under construction right now, leading to high inflation in future years?
So I think there are two things going on quickly. One is just there's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about. That's not something we can affect. Well, there's also, if I may say, in the short run, rates are high, and that's going to weigh on housing activity. But the best thing we can do for the housing market, the absolute best thing, is to restore price stability so that rates come down and so that rates can be at a level that people can afford. But don't you think that the restrictive monetary policy the framework you all put together undermines long-term price stability right now by reducing the supply? No, I mean, I think it restores price stability. The point of higher rates is to... So you don't think the higher rates is impacting future supply of housing? So I think what that does is, I think interest-sensitive sectors like housing are very much directly affected when we cut rates or when we raise rates. That's right. But that's part of the mechanism for restoring general price stability.
So keeping the high interest rates does not impact future supply of housing.
It does not, you know, over the long,
I need to go back to talk to
over the long
women
run,
that the
the
study.
Fed will not be, our policy will not be a driver of longer run housing supply in the United
Okay,
States.
let me ask you, what is the difference? And I'm honestly confused. I want to learn here. And I'm sure people listening to this want to learn. What is the difference between demand-driven rent inflation and supply-driven rent inflation? Like you guys use these terminology. What is that? How do I communicate that to the public? What is the difference between supply-driven versus demand-driven rent?
You know, those are not terms that we use particularly often.
What's supply-driven formula?
That would mean that, you know, that there's not enough supply to meet demand, but at the same time, it also means there's more demand than there is supply.
So are you guys ignoring that?
No, but as I said again, our policies will not affect in the long run.
No, I'm being
either
serious,
demand
'cause I
or
see somebody
supply
behind you
in
kind of
housing.
shaking. I'm being serious, y'all. We're talking about a housing crisis that is getting worse right now because we're not paying attention to future instability that the current rates, and you can raise your eyebrows and all this stuff behind. I don't know. I mean, do you understand? Like, I come from a community right now that I believe is now being impacted by the current framework that you're putting together, that I do feel like it's going to be long-term effects on the housing crisis, and you're ignoring it.
No, we're not. Actually, we think the very best thing we can do is to fully restore price stability at the aggregate level. That will be the best thing for homeowners and for home
Even though the
builders and
housing
everybody
supply
else.
has been
That's in the
impacted by the
long
high
run, that
interest.
is the single
But
thing
Chairman
that
Powell,
Congress
you
has
see where I'm
assigned us
coming
to do.
from. But you see where I'm coming from. It is impacting future supply of housing, right?
Not in the long run, no.
Okay. Well,
Gentlewoman's
Mr.
time
Chair,
has
thank you.
expired. The gentleman from Wisconsin, Mr. Stile, who's also the chair of our subcommittee on digital assets, financial technology, and artificial intelligence. You're recognized for 5 minutes.
Thank you, Chairman Hill. Thank you, Chairman Powell, for being with us today. I want to dive into two actions the Fed's recently taken to get a little additional color on. Yesterday, the Fed announced that reputational risk would no longer be a component in bank exams. I viewed that positively. I viewed reputational risk as often being a catch-all for political bias. I think it's positive to depoliticize bank exams and instead focus on the core and measurable risks. Could you provide color as to whether or not any new or new information came to light that led to the decision of the Fed to remove that yesterday?
I'm not aware of any new information. No, we just think it's the right thing to do, and of course made an announcement on Monday under Governor Bowman's, Vice Chair Bowman's leadership.
Why would it not have been done previously if it's the right thing to do? I agree with you, it's the right thing to do. Why was it? Any timeline as to why that was done yesterday versus previously?
No, I think this is a problem that we came to understand as a problem over the course of the last couple of years, and you know began considering what's going on here. We're hearing a lot of reports of debanking and that sort of thing, and over the course of really 2024, came to the view that this was a serious problem that we need to address, and we've said that publicly, and now we're doing this, and so are the other agencies, by the way.
I appreciate you taking that action. I do agree that there were real political bias in some of those exams, in particular as it related to regulated entities engaged in the digital asset space. Let me shift into the digital asset space, if I can. Another agent withdrew several statements on digital asset related risks that deterred bank involvement in particular. You in the Fed and others, the Fed have spoken positively about the House and Senate work to regulate stablecoin in particular, opportunity to the Fed. Have you seen an identifiable shift in banks or other regulated entities as relates to engage in digital space?
You know, I would be the one to be picking it up first, but would reflect evolving thinking and the evolving status of the crypto industry. And I would expect over time we'll see more activity
in the digital assets or crypto space.
So our view is that banks get to decide who their customers are. That's not our decision. And So banks provide banking services to crypto. These banks are, protective of safety and soundness.
Thank you very much. So let me shift gears because I want to give you just a little opportunity to comment on the housing sector once again, a little freedom to that area. You correctly impact on the housing market is shelter and housing costs are significant driver why many families can do the things that they need. Can you provide colors to how you're analyzing the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs. And high financing costs. In terms of inflation, we look at something called equivalent rent, and it's been that's been the part. Really, it's been the service inflation that's been stickier than other parts of inflation. So that's good news. It is showing into measured inflation. Again, in the long run, the best thing
What data do you think is leading to the reduction of the rent equivalent?
I just think it took time. So the thought is when you would, if rents come up every year, you would think for 2 years for a lack of growth in rents to show up, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation. I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where.
Years back, gentleman from California, and Mr. Licardo was recognized for 5 minutes.
Thank you, Mr. Chair. Thank you for your testimony today. Critical data is collected by the Bureau of Labor Statistics to help formula indicators that we rely on to understand. We are certainly hearing a lot about our workforce, and specifically about the elimination of many of those positions in BLS. And now we have a proposal in front of Congress to cut $56 million. To have reliable indicators to make good decisions upon.
I wouldn't say that I'm concerned about the data today, although clearly there has been mild travel is something I'm concerned about, and that is measuring the U.S. economy carefully and well is a project that's been going on, and we're getting better at it for 100 years and more. And it's really important, not just for the Fed, but for Congress and for businesses, frankly, to know what really is going on in the economy. What's happening is to just continually try to get better at measurement of what's happening in the economy. And I don't like to see that, it's more difficult for the private sector and for you and for us. And I don't like to see that direction.
I agree. Thank you. I appreciate that it's not your role to comment on the advisability of specific policies, but given your critical role in ensuring price stability and reducing inflation, I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter, because it takes time for tariffs to work their way through distribution chain. Often what you have on the shelf today that may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. It happened to meet with an unusually large number of business people in this last FOMC cycle. And that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know. And we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
You know, that very much is something that companies will tell you that they do if they can't cover the losses on the thing that's being. But that's certainly a possibility, and that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman. And finally, there's indications in the introduction of the report that the Fed is losing its ability as we see interest rates getting closer and closer to the minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates, but we're at higher levels of interest rates now, so there's significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the past, but in September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time. And I think so. Can you revisit that again? What the Fed was thinking at that time, because it seems to be somewhat of an enigma now. It stands out as, why was this done at that point?
I'd be glad to. So, first of all, the inflation and employment readings were very similar then to what they are now. They weren't terribly a tenth or two.
Right.
But the difference then was, you mentioned the employment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it. There really hasn't been an experience, or hadn't been an experience in the modern era in which the unemployment rate has gone up close to 1% that hasn't been followed by much higher levels of unemployment and a recession. So I think that point we're talking about, the 5.3%, so definitely very restrictive level. I was quite clear about this. So that it was all about the labor market. Inflation was the same, and unemployment was roughly the same, but it was the reach with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September. And it seemed like right at the end of the day, do we think is the right thing, with the right thing to start doing that? I don't know where that stops. Once you start considering and stuff like that, where's it up? You know, so
Not that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And and I don't bring this up because I want to kind of make a point. Did the Fed do the right thing or not? I bring it up because it seems like everything's in place on the same move. I know this a little bit on watching, but is there any lesson there? I mean, our position as big as a 0.5% cut again?
Well, look, as I said earlier, that some significant inflation will show up from tariffs now, and we can't just ignore that. But we're not. We're just saying let's wait and see more. That's all we're doing. And if you want here, so it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. Going to forecasted to go up, saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If that would matter. And if we saw the labor market weakening, that would matter too. But we don't see these things.
Supply chain 2020 is bigly related to COVID. Myself and others were in our districts, and we're specifically talking like you when you make a decision about where we're headed in the future.
Very much so. I think that's one of the great, well, won't call it a great thing, but one of the lessons to be taken from the last episode is supply chains really matter. We're watching that carefully. It's too soon to say really on that. We're not seeing it yet, but
Gentleman's time has expired.
Thank you, Chairman. Yield back.
Thank you.
Chairman Powell, as a member of the Intelligence Committee, I'm deeply concerned about the threat of Iranian cyber attacks on our financial system as retaliation for our strikes on their nuclear facilities. In its cybersecurity report last year, the Fed acknowledged that critical infrastructure, including financial services, is at risk with Russian political tensions. Iran has a history of targeting American infrastructure companies and financial institutions and banks, which could obviously threaten and cause economic damage. What actions is the Fed taking now to monitor and defend against Iranian or proxy cyber threats targeting our country's financial institutions?
So we're in touch with the other regulators and the parts of the government that work on cyber, as you know, and we're in touch with the banks to say, for people to be on the alert for things like that to happen, and also we're on the alert because target as well. So you're right to raise it. It's a big issue, and
I feel like you have the resources right now to be prepared for that?
Yes, I mean I think we do. We spend a lot, and the government generally spends a lot on these things, and but you can never ever be comfortable in this area because the bad guys are always getting better. So we need to get better.
Thank you, Chairman. Switching gears, the president and members of his administration have recently called you out, various name calling for certain decisions you've made. I know that some people worry that the president's bullying will impact your decision making. I know you work together, and I know that and respect obviously your independence greatly. Anything you want to add and give you a chance to read your independence to the American people?
Yeah, I was focused on one thing, and that is we want to deliver a good economy for the benefit of the American people. That's it. And anything else is kind of a distraction. I don't mean to refer to any particular thing, but we stay focused on that task all the time. We always do what we think is the thing to do. And, you know, we live with the
And the Mr. Too Late and all that stuff. The American people shouldn't worry about that. You're focused on being independent.
just, yeah, that matter a lot for people's lives, and that really concentrates the mind. You know, you want to just stay focused on that task. As long as you're sitting in chairs that we on the task, what you think, take the consequence.
You've put coins as a form of money. Payment stable coins are already being used for wholesale payments as well as dollar-backed payments. Stable coins. Given their designed to maintain a stable value and be redeemable for U.S. dollars, should the SEC for counting misses?
I think it's a big thing that we need.
Have also caused rocket. The CBO estimates that interest payments will cost the U.S. $1 trillion in fiscal year 2026, continue to rise to almost $0.8 trillion. How do you see us continuing to be able to afford to pay off our debt at this rate? Obviously, worldwide are having that impact. Are you worried about this global issue?
You know, fiscal and Italy is not has been on an unsustainable path, and you know, I'll limit myself to that.
Purchases on things like cars and homes as a result, while it's being crushed by these price hikes and obviously the president's tariffs. What do you have to say to Jersey families who are struggling with higher costs and how you look at how they should forecast themselves for their own families?
We're committed to returning inflation sustainably to 2% and keeping it there long. And what we know is we had cuts 100 basis points, so they come down, and that will depend on economic.
Yield back. Thank you, sir.
Gentleman yields back. Gentleman from Nebraska, the chair of our Housing and Insurance Subcommittee, Mr. Flood, you're recognized 4 or 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, later this week, the banking agencies will be proposing changes to the supplementary leverage ratio, which we think are long overdue, considering the Fed in 2021 indicated that they would soon put out proposals for reform to the SLR and never actually did. However, our understanding is that the proposal being considered this week will not allow for treasuries to be excluded from the SLR calculation. Secretary Bessent earlier this year that such a change could serve as a boost for banks and their ability to intermediate in the treasury market and could potentially pull treasury yields down 30 to 70 basis points. Chairman Powell, do you agree with the Treasury Secretary's comments on the potential positive impact of SLR reform on the Treasury market? And what is the rationale for not excluding treasuries from the SLR calculation in the proposed rule?
I agree that when the leverage ratio is binding, it discourages banks from
Set a case efficacy chain, also known as chain of efficacy, a digital chain. A chain is only as strong as its weakest link. Educate, efficiency, effectiveness, and evolve. So whether you are doing market research, studying, doing market analysis, or making a critical financial decision, get the latest breaking, developing market news in the cryptocurrency markets at www.efficacycoin.com. Efficacy Cryptocurrency News is powered by Case Capital Markets.